My name is Elise Katz, and I'm a CPA and a senior manager here in Phoenix for Eide Bailly. Prior to my time at Eide Bailly, I was a revenue agent at the IRS for about 10 years, and now I represent clients for our firm and navigate procedures in front of the IRS. So today we will be going through a high-level overview of some IRS exam procedural updates. We're going to go over employment taxes, the employee retention credit, and some important information about IRS collections and penalty abatements. And for my particular portion, I'm going to go over IRS updates, some of the exam campaigns that we're seeing now within the IRS, and then I'm going to focus on one particular area, which is the microcaptive settlement that's now being offered. So the last 18 months has been constantly changing for the IRS since the pandemic. Everyone transitioned to working remotely, and for a couple of months there's pretty slow while everyone was moving through that transition. But recently, in the last 6 months, we're seeing a large uptick in IRS exams. And now everyone's transitioned and settled and they're more efficient. I'm sure a lot of you are happy with some of the changes that have come out for electronic correspondence, submitting information with temporary changes in digital signatures. The IRS now allows email correspondence for exams. You can send secure links. So it's actually been really efficient. And I'm hopeful that some of these changes are here to stay. The IRS has extended on their MOU for digital signatures through the end of the year, December 2021. And we'll see after that date if some of these changes become more permanent. The IRS is now attempting to hire a lot of individuals. I think they've requested like over 6,000 employees for fiscal year 2022. There's still no field examinations, but with all of the new employees and agents starting, everything's really ramping up. In the past 10 years, the IRS really hasn't hired, and there's been tons of staff shortages, which the commissioner had come out and said during an interview, this added to the increase in the tax gap of like almost $1 trillion. The tax cap hasn't officially been disclosed or reported since 2010, but that's what they're stating recently. So now they're just trying to catch up with hiring. Attrition has been really bad, and the IRS has been really hurting. So now we're really seeing a push to hire with the new IRS campaigns coming out. And then even most recently on the IRS forum, they're just promoting a push and heavily recruiting. If you've seen on LinkedIn or any of the job boards, pretty much all areas of the IRS is hiring, from collections, exam, service center, pretty much everywhere. So I'm going to dive into a little bit of some of the exam areas of focus and the campaigns that we're looking on. In addition, some changes, procedural changes to the Bipartisan Budget Act, if you're familiar with that. All right, so as you know, there's a couple different ways that the IRS picks returns to be selected for exam. One is through regular diff score examinations, and those are compared against a statistical model and norms. And if anything is outside of that norm, it's selected for examination. Also, the IRS has certain campaigns in which they basically redefine compliance work and have used to build a supportive infrastructure, because the program allows them to focus on areas due to their resource challenges. So they can just do a more strategic planning model and deployment of resources to focus on different areas. Some of these campaigns are the foreign tax credit, FATCA filings, foreign earned income exclusion. Of course, we always see high income non-filers or any non-filers. That's always going to be an area of interest. Claims, if you file any amended return, there's always going to be a risk of exam. The IRS is going to pick that up for review, whether it's just reviewed at the service center or gets pushed down to actual agent for exam. Anytime you're amending a return, just be cognizant of that. We've got a lot of more foreign issues regarding 965 avoidance, Of course, the microcaptive insurance, which I'm going to talk about here in a second. Related party transactions, any sort of loss, the IRS is going to look at NOLs, carryback, S corps. They're focusing on heavily. Reasonable compensation, distributions, and then losses in excess of basis. Conservation easements, we have a lot of reviews over the TCJA campaign, and now the IRS is also focusing on virtual currency, trying to figure out what that's going to look like moving forward. I know there's a new checkbox in the return, and within every IRS exam, the agents are always going to ask about virtual currency. All right, a little procedural change. If you've experienced it or not, it's pretty convoluted so far. The IRS is still trying to catch up about what the Bipartisan Budget Act means and how they're operating. Pretty much, this is a repeal of the current partnership audit rules, TEFRA. If you've been through any sort of partnership exam prior to 2018, you were subject to those TEFRA rules. And now, starting in 2018, every partnership that's going through an exam is subject to the central audit regime. And 2017, they could elect in, but 2018, it's going to be automatic. So what is BBA exactly? Like I said, it replaces TEFRA, but all adjustments are made at the partnership level. So a partnership being a flow-through entity, it does not compute or pay any income tax upon filing a Form 1065, but instead the tax is going to pass through, any profits or losses to the partners. However, when a partnership is examined under this BBA regime, any partnership adjustment resulting in an imputed underpayment or a penalty, addition of tax, interest, any additional amount asserted by the IRS is going to be assessed and collected at the partnership level. And that's going to be on the highest effective tax rate of the partner. That's how they're going to compute the tax. So it's different than TEFRA, where all the adjustments were automatically pushed out to the partners. This is going to stay at the partnership level. Like I said before, the elections are automatic starting in 2018. So all partnerships are covered unless you specifically elect out. And there's going to be specific requirements that you need to meet in order to do that. So in order to elect out, you have to prepare a statement. You must include a disclosure, name of the taxpayer, TIN, each partner, and then it must include the statement here, disclosure from the IRS. And there are some conditions that must be met. You have to have fewer than 100 partners. If you have more than that, they're not going to let you elect out. And of course, this is something that needs to be done on the tax return. Going through an exam, the IRS will give you opportunity to adjust this moving forward. A bunch of guidance has been issued regarding BBA. There are a couple of pubs floating around, and specifically this flow chart that'll pretty much make anyone's head spin. That kind of goes over the flow of the BBA procedures during an exam. For the most part, the beginning portion is the same under this filing audit section. Where it really gets tricky is towards the end of the audit process and post-audit, where you have that 270-day window and issuance of the NOPA, and that's NOPPA. It's different than what the LB&I division describes as NOPA, the Notice of Proposed Adjustments. This is a notice of proposed partnership adjustments. And actually, technical services, after the agent closes the exam, is going to issue this package. And this is going to include the time frame where you decide whether you're going to dispute the findings, whether you think the IRS is correct in how they're imputing the partnership adjustments based on the highest effective tax rate. So this is kind of the part where everybody still doesn't know how things are going to flow, because it's new, right? All of the exams prior to 2018 weren't subject to this. And since the IRS is behind in what they examined, we're just starting to see these 2018 exams come through with this BBA. So take a look at these pubs and this roadmap and just kind of familiarize yourself, because if you have any of these exams, it's going to come up. All right, I know that's a lot for BBA, but I want to jump in a little bit here to the Microcaptive, since we don't have a ton of time. I want to save room for the other presenters. So one of the big, I'm sure you've heard of micro-captive insurance transactions. The IRS has claimed that it's an abusive tax shelter. They've added it to their Dirty Dozen tax scams list. And it's specifically these 831B transactions. It's not the F&I captives. There are some captive arrangements that are legitimate that the IRS has actually delisted. So it has to be, like I said, that 831 micro-captive insurance arrangement where you would have disclosed this on your tax return as a reportable transaction with Form 8886. The IRS has sent out a bunch of warning letters, letter 6336, to anybody who's disclosed that they've been involved in micro-captive campaign. Essentially, it's a warning letter that says, hey, we know you're involved in this. Let us know if you're no longer involved in it, when you've closed down the captive, or it's giving the taxpayers an opportunity to amend their tax return, remove the insurance deductions before the IRS comes and audits them. It's just a warning letter to say either get out now or you're probably going to get audited. Or consult with your advisor again and make sure that this is valid and something that you want to continue doing. The IRS has done this because they've recently won 4 big cases that the tax court has held up. Most recently was the Kaler land case, where another micro-captive arrangement failed to qualify as insurance for federal tax purposes. And it's primarily due to intent as to why the captive was created in the first place and how the captive was formed and all the paperwork and how they operate in general. And most notably, they've sustained penalties in the latest one, which could have been considered 40% penalties under economic substance. So, I mean, that's a huge penalty that you don't want to face, 40%, if the IRS comes to audit you. However, the IRS has now started this tranche 2 settlement. So if you responded to the 6336 letter, you're still involved, the IRS has picked you up for examination, you can come forward and say, hey, we understand, the IRS has won a bunch of cases on this. I really just don't want to fight it. I want to settle into an arrangement in this tranche 2 settlement. And it's primarily 2018 and beyond because 2017 statute is closed. So the settlement's fairly favorable if you're only looking at 1 or 2 years of disallowed deductions. But what the settlement does is they disallow 100% of any of the deductions claimed for captive insurance premiums, and then they're offering a lesser penalty. So initially, like I said, you could be facing up to a 40% penalty under that economic substance, but under the tranche 2 settlement, the IRS is offering, if you enter into it, a 15% penalty, which can be reduced down to 5%. There's a couple of criteria that you need to meet. First off, you need to reduce it by 5% if you are not involved in any other reportable transactions, and you're going to have to sign a declaration under penalties of perjury that that's the case. And then it'll be reduced further by another 5% if the taxpayers relied on advice from an independent tax professional, and they will be required to sign a declaration as well, claiming that that's true. So, while the settlement's good and you can get reduced penalties of 5%, the examinations are still fairly lengthy. The IRS has offered a streamlined procedure, so you can skip a lot of the interview process, the heavy IDRs, but it's still taking time to ripple through all the calculations, and it's still overly burdensome. So it's not too late if you have received any of those letters, the 6336. respond or amend or consult an advisor as to what needs to be done to move forward, because yeah, the exams aren't fun, but at least they're offering a settlement and a reduced penalty, because prior to this settlement, for a while, the IRS wasn't offering anything. Okay, well, I think that ends my part. If you have any questions, please enter it into the chat and we're going to kind of address them at the end. And I'm going to let Stephen take over. He's going to go into some of the new changes with employment taxes and the employee retention credit.
Good morning. My name is Stephen Weingarten. I am a senior associate with Bailey in Phoenix, Arizona. A little bit about my background. Before joining Bailey, I was a revenue agent with the IRS, specializing in employment tax exams. So whether that's working with worker classification, reasonable compensation, or just in general filing and compliance type issues. And from there, I worked for one of the top 5 payroll companies in the country. So dealing with PEO wages or third-party pay wages, overseeing their payroll tax operations. So a good amount of experience with both at the federal and state level, but today we're going to focus on the federal level. And we're going to go over these 3 main topics. The 2020 employer Social Security deferral, where it's at now, and what are the next steps to be taken if you did take that deferral, more recent changes to the 941, and touch on some of the more recent updates to the employee retention credit for 2021. So for the employer Social Security deferral, starting back in end of March of 2020, it ran for the year 2020, and it was filed a quarter by quarter basis. It was only for the employer share of Social Security. Originally, when this came out, it tested a lot of the capabilities of the different payroll softwares, as many put Medicare and Social Security together and just had employee FICA versus employer FICA. And it caused errors when they're originally trying to take this credit or this deferral in second quarter of 2020. From there, it kind of snowballed, and we have seen some exams coming up with that. However, assuming the credit was taken successfully for 2020 for the deferral, you started to receive letters from the IRS, letter 30647, or sorry, C, saying what your amount is. Now that letter is going to come quarter by quarter. So if depending on if you took the credit for all or the deferral for all 4 quarters, you will receive a letter for each quarter. That letter is going to state the total amount that you deferred for the period. It does not give just the amount that's due December 31st of this year. So you have to go and kind of do a double check, because it doesn't really spell it out well in the letter that only half of that is due. The other part, assuming you have fairly regular wages, it's going to look like a duplicate, because you have similar numbers for each quarter. When you're going to make these deferral payments, the IRS has now set up an EFTPS, a deferred Social Security tax option. That is the best place to make this payment, because you can direct it. It is for deferred Social Security. You can pick which tax quarter you want, and it will be properly applied to that period. For any of you who have made EFTPS payments, you know that there's many different options, and when it does originally go to the wrong period or wrong tax type, trying to work that back and reallocate can become an issue. One other thing to keep in mind is, while it would be nice if you could make a deferral payment for the entire 2020 year, you need to make that deferral payment quarter by quarter basis. If not, the IRS will take, for example, if you had $2,000 deferred for quarters 2, 3, and 4 of last year, and you make a $3,000 payment, they're going to apply $2,000 to whatever period you apply, and then the other $1,000 will be applied how they determine, which will then leave 1 quarter showing that you did not make a payment. Again, it's more things to have to go work back and correct. For those of you that have not received a letter, or you're working with someone that were not involved with their 2020 941 filings, account transcript, the IRS do have a line showing what was deferred. So you can go in, you can pull updated account transcripts, and you can see what was deferred for each quarter, so you have that total. And also it's a way to verify that it was processed properly. I know a lot of softwares between the payroll and the tax filing side did not properly calculate and report those credits or those deferrals, especially for second quarter, and resulted in additional issues. So you may have attempted to take the deferral, but it was not properly processed as such. There's still ways to correct it depending on what would be best, but that's a way you can verify what is there. But here's a little about the account transcript part. It should be one of the last transactions on the account transcript. It's code 766 and it has section 2302 deferral amount. This is the total amount that was deferred though. So when you're going in to make your payments, make sure that you are splitting that in half. If you'd like to pay more early, by all means, there's nothing stopping you from doing that, and the IRS will apply it to the balance that's due December 31st, 2022. It will not, if you were to in error pay extra, you pay the full amount, they're not going to walk that back and give you half of the deferral payment to then pay it in 2022. They're just going to apply it to your balance and move on from there. And cannot stress it enough, make a payment for each period. By combining it to try to make one payment, the IRS will have an issue allocating it properly. And then, yeah, using the deferred Social Security tax option, it's not a deposit, it's not a balance due on your return, anything like that. So if you did make payments early in 2021 for this deferral, for some reason you were ahead of the game, this was not an option, it's worth going back to double check and make sure it was applied properly. Just so that way you have that documentation that the IRS applied it properly, and that way you don't have any surprises come 2022 thinking you made your deferral payment, but the IRS did not apply it as you intended to, and it becomes a different issue to deal with. So for the Form 941, it has been revised again. Since beginning of 2020, it has gone through 4 different changes. The most recent change came late in June of 2021 for the second quarter of 21 filing period. So right before you're getting ready to start using the form and doing your reconciliations, it changes again. Some of the main changes, there are additional lines. The COBRA premium assistance lines were added, lines 11E and 11F. Also, depending on any sick leave or family leave wages you have, there's a slight change to it. And it's for your, and that's going to be based on your pay period dates, not just the pay date. For example, wages that were, if you used sick leave wages were utilized in March, but the check date was actually in April, those are treated different than family leave or sick leave wages that were used in April and then paid in April. It's just the way it's going to be split out onto the lines. Changes. So lines 5A1 and 5A2 are used for wages that were paid in second quarter for leave taken before April 1st. So those would be those wages from first quarter that weren't paid until second. For wages that were paid in, for leave taken in second quarter and paid in second quarter, you're just going to put it all on line 5A. There is a box when you're looking at the 941 directly to the right of those lines that brings it up. So it's also kind of a reminder to make sure it's being properly allocated on the 941. Some of the other changes with the 941, it is now ballooned to have 5 worksheets included. Those worksheets cover a range of topics, and you can also plan ahead. Worksheets 1 and 3 address credit for qualified sick and family leave. Worksheet 2 addresses employee retention credit for the second quarter of 2021 only. Worksheet 4 is employee retention credit for the remainder of the year as currently decided upon. If there are any more legislative changes between now and the end of the year, that is always subject to change. For third and fourth quarter, the worksheet is shorter. So that is a positive change, a little more streamlined. And then the last worksheet addresses COBRA premium assistance. So if you were to assist any of your employees with that matter, that's where you can calculate and make sure it's being properly taken on the 941. Depending on your software situation and how you prepare your returns, whether you're using some type of, whether you're manually doing the worksheets or it's being automated through a software. I would recommend doing is going through those and reviewing what the final return is as soon as possible. We still have a little over a week before the due date for those 941s, just to make sure your payroll software is properly communicating with your tax software to take those credits and deferrals and any of those other items properly and reporting them. One issue I unfortunately know too well from last year is if you have one company doing your payroll software, another has tax software, the way company A treats the deferrals may have treated as a negative number while the tax software was anticipating a positive, and it creates issues where it threw off your numbers. Because this was such a recent change right before filing started, I would make sure that they're communicating properly with one another to that way you're not going back and trying to file a 941X after the fact when you could have caught it now before going into that portion. It's just a little more streamlined, and as Elise said earlier, when amended returns get a second look, there's so many changes with the 941 over the last year and a half. So if you can make those corrections before the filing due date, it just makes it that much more streamlined and efficient and less issues to deal with on the back end. So we're going to talk a little bit about where the employee retention credit was and changes in early 21, and then where it is now. It unfortunately changed, well, not unfortunately, but did have another update in April. So just another change to consider and make sure stay on top of. So for 2020, the refundable credit was for March 13th through the end of the year, and it was supposed to be all resolved at the end of 2020. It was taken based on the two tests were either full or partial suspension of your business, or the drop between your gross receipts from 2019 to 2020 for the same period was a 50% change. Now, and that was for 2020, those rules. For the full or partial suspension, I recently looked at this with one company and trying to get into the details of what the orders specifically were that impacted them. Unfortunately, in their state, the orders from the governor were fairly vague for an essential business on what they should or should not do. And it left it a lot open for interpretation. And in this case, the more explicit and detailed the order was, directing you to shut down as opposed to you being proactive and more cautious as a business, makes a big difference. A business being cautious and restricting access versus the government mandating it makes a difference on you were not partially suspended if that was your choice. Also, then once those restrictions lifted, even if you continue to operate as you did previously, once those orders came off, the government partial suspension or full suspension test is no longer met come that point. So if you are relying on that portion for 2020 or 21, I would go find and save whatever order it was that you were using for that period of time. I know going back and trying to find the original mandates as opposed to articles about what either any level of government is saying or recommending, but exactly what the details were. That way you have that if the IRS was to come examine it in a year, you have that backup for your position. That way you're not trying to look for that information to support why you took the credit later on. Also, if you're using it for the change, for having a substantial change, again, I would recommend having those reports, either summary, just something to substantiate and follow up, and it's with your 941. That's a little easier to go back and recreate for your business, assuming no software changes or whatnot complicated. But the more you have to document it with the return, if the IRS ever does come ask a question later on, you're prepared with that documentation ready to go. Just one less thing to have to be concerned with. So for 2020, assuming all tests were met, the credit per employee would be $5,000. And for going into 2021, that changed. So now the credit has increased to 70% of qualified wages. So from $5,000, if you had the most, if you hit the wage limit for an employee, now $77,000 credit. They also made a change to what was considered a significant drop. For 2020, it was 50%, and it was then increased to 80%. For taking the credit in 2021, you're still comparing yourself to 2019. For the same quarter in 2019, you're not comparing to 2020. For a business that was not operating for the same period in 2019, you can compare it to 2020. There is also another option to be able to compare it to the previous period. So in this case, second quarter, looking at first quarter of 2021 instead of back to 2020. But given most of the initial impact, comparing 2019, before there were any implications from COVID-19, 2020, most businesses were impacted. You'd rather compare it to 2019 to take the credit now. So it gives you a little more options. They also expanded what would be considered part of the Employee Retention Credit. And this was the initial part under the Consolidated Appropriations Act. This was early in 2021. You do not have to meet the same test from quarter to quarter. You could have a quarter where you have a full or partial suspension of operations from an order, and you could take the credit for that quarter. Once the order is lifted, if you still had an impact to gross receipts, it met the significant drop threshold, then you can utilize that test. And it's not it's an either or situation to be able to utilize this credit. And it does not have to be the same from quarter to quarter or continuous running. So you have that extra part to be able to consider. Now, along with that initial credit, or the Consolidated Appropriations Act, the small employer threshold increased from 100 to 500, which opened it up to many more businesses. With that expansion, it does get into the details on how you're able to claim the credit and which employees you can utilize it for. If you're in that area where you're comparing to your average employees for 2019, not employees today, but if you're in that range of 100 to 500 employees on average, it's worth going back to double check, do you meet this threshold, and what it would be. If you're over the 500 and you're not in that small employer test, there's no change. If you're under 100 already, at the test for 2020 standards, there's no change there, but it did open up for a whole lot more employers. There are also changes to which type of entities could take the credit. So you may have been unable to take it for 2020, but now it's changed and it's worth going back to re-examine your options. Also, for those that took the PPP loans for 2020, that did originally prevent you from taking the employee retention credit. That is now changed. You cannot use the same wages for both, but you can now utilize it for this additional part going forward. So if you have partial PPP wages and regular wages in there, you can still, for the other wages, you can still take this employee retention credit. And the main thing is, if you are in those situations where you have some of the credits that go together and they're overlapping in some manner, the more documentation, the better. Because based on the amount of changes to the 941, the IRS hiring and expanding their operations, they're going to be going through training, and these are going to be a lot of those training cases to look into and verify that these credits or deferrals were appropriate. The more documentation you have up front, the faster you can resolve those issues and move forward with your business, instead of being stuck going back and trying to find out what happened a year or two prior to verify why you did what you did. So kind of going with that point, as the 941 changes, the IRS has to change accordingly. The IRS today, examiners are not going to be looking at these 2020 and 2021 returns yet. They'll be looking at them in 2 years. At that point, though, trying to go back and can remember what happened at the time, what the guidance was at the time, and even just for the 941 which different return you were using for each quarter to be able to document yourself. One thing from being on the IRS side, I would always ask for copies of the 941s to be able to have a full version of what was actually filed instead of just a summary version. With the changes from quarter to quarter, the details that go into it, and if your software or you manually produce these worksheets that go with the 941, having those records saved to then go and get you from your payroll data to what was actually put on the 941 makes a huge difference. The more questions you can answer up front and quick and direct, the better the examination will go when these do become issues. With the expansion of the credits and the deferrals from 2020, it's a lot of money moving around and being sent out from the IRS. With that comes more questions, and were those valid credits taken? So there will be more scrutiny on that end, and to make sure that these returns were properly prepared, and the IRS did not in error give out too much money because credits were taken in error. I have started seeing some notices for miscalculations on the 2020 returns, and they're coming out as just mathematical adjustments. And here's your balance due. Having that documentation, or even if it is a valid change, but there are penalties assessed, look at the details of your payroll software. Like I mentioned before, a lot of payroll softwares were able to get away with having employee FICA versus employer FICA because they were all treated the same way. At the end of the day, it was all the same money. It could break it out on the return, but it was an easier way to summarize reports. However, because Social Security versus Medicare were treated differently for the deferrals, it caused issues using that software. And some, did take the deferral on Medicare as well, which then leads to these mathematical adjustments. Having the reports from your software to show how you calculate it, the more evidence, the more records for why you did what you did with these changes on the 941 makes a huge difference when you're looking at penalty abatement down the line. So the more documentation, if you partake in the employee retention credits, having the orders from whatever level of government impacted you and restricted your business, have that saved somewhere, ideally with your returns, but somewhere that down the line, whether 1 year, 2 years, you can find that information to cover yourself at that point. Because I know just going back to look for some of the orders, some states were changing them so often that it's hard to find which one was applicable at which time. And then getting into the details of what was explicitly directed versus interpreted and being more proactive as a business makes a big difference. At this point, I'm going to turn it over to Margarita. She'll get into some collections and penalty abatement issues. And I believe she's actually going to continue the employment tax fund to start.
My name's Margarita Stone, and I am a senior manager with Eide Bailey. I work out of the Rancho Cucamonga office in California. And so I am an attorney, and I've been working in tax controversy collections for the past 15 years. So to get started, I'm going to talk about today IRS collections and penalty abatement. So kind of to move forward with, Stephen's portion with employment taxes, essentially when there's unpaid employment tax, the IRS takes that very seriously, especially. So any unpaid employment taxes is usually referred to a revenue officer. A revenue officer, their job is strictly to collect on the unpaid tax. Like Elise mentioned earlier, the IRS is, moving forward with hiring, and that includes hiring a lot more revenue officers so they can bring money in, to the government. And so the IRS is getting, believe it or not, kind of more aggressive, and especially with unpaid employment tax. More so. So in terms of unpaid employment taxes, the way the IRS looks at it, they kind of divide it where it's the employer portion and an employee portion. So the unpaid employee portion consists of 100% of the federal income tax withholding, 1/2 of Social Security, and 1/2 of Medicare. So the IRS calls the employee portion the trust fund recovery penalty. So when a revenue officer is assigned to a case, one of their first assignments is they want to pursue this trust fund recovery penalty, which includes a investigation. They call it a 4180 trust fund investigation. And the IRS is trying to determine who are the responsible parties that should have, made the payroll deposits and failed to do so. So the two elements that they're looking for is who's responsible and did they willfully fail to collect or pay the tax. It's fairly a low threshold. They can go after one individual, they can go after multiple individuals. You could be a controller, an officer, anyone who signed the checks. And again, they can go after multiple people for the same liability. And so once the IRS determines who these responsible persons are, they can personally assess the trust fund recovery penalty, which again is the 100% federal income tax withholding, 1/2 of Social Security, and 1/2 of Medicare. So this actually gives the IRS two sources to collect from, because they can collect the unpaid tax from the employer, and they can also collect it from the individuals that were personally assessed. On top of that, when the IRS does do the assessment on the individual, there's interest accruing on both sides. So if, employers out there, if they, got behind, number one, it's important to be in compliance. So make sure you stay current in the current quarter. Don't try to catch up. It's more important just to be current and move forward. But number two, if there's any extra money that comes in, we do want those voluntary payments to be applied to the trust fund portion. And obviously, if the trust fund portion is paid in full, then there's no need for the IRS to do this investigation, and the remaining liability does stay with the employer. Okay, so some new updates. So January 25th, 2021, the IRS rolled out a new online option for tax professionals. So before, when submitting a 2848 power of attorney form, you would fax it in. When COVID happened and the systems kind of went down, we had to mail in the power of attorney forms. But now we are able to upload these forms, and you would need to have access to e-services. So you would need a login and have that permission from the IRS in order to upload the power of attorney forms. But if you have access to e-services, now you can upload these forms. And as Elise mentioned earlier, that these can be electronically signed now. You don't necessarily need the wet signatures. And so now you can upload those, and it's a faster process as well. The IRS is still backlogged in processing power of attorney forms, where in the past they used to be maybe 5 to 7 days. Now they're kind of putting out a disclaimer that it could take 30 days or more for a power of attorney to be on file. Also, since COVID, IRS has made some kind of changes to be more flexible and help taxpayers that have been impacted by COVID-19. So they have a taxpayer relief initiative that started in November of 2020. So there are different options for, again, taxpayers that can't afford to pay their tax in full. So short-term payment plan option is now extended to 180 days. You can call and request that. If you try to do that online, I think online limits you to 120 days. So if you need the 180, you do need to call that in and request that from a person from the IRS. Accepted offer and compromises. So if an offer is accepted, for example, let's say the IRS agreed to settle a debt for, let's say, $20,000, and now a taxpayer is struggling to pay that $20,000. The IRS is willing to work with taxpayers and offer some flexibility on how they can make that payment, maybe give them an extension. I think as long as you communicate with the IRS and show good faith, they are willing to work with you. IRS has added certain new balances to existing installment agreements. This only applies to individuals and closed businesses, but essentially if someone had an installment agreement and they had balances, Form 1040, and let's say from 2012 to 2018, and now when they filed their 19 return and had a balance for 19, the IRS automatically included that 19 balance into the installment agreement. So the agreement didn't default and they just kind of added that balance in. Also, so generally, if a taxpayer owes more than $100,000, the IRS is going to require financial information to determine what that taxpayer's ability or inability to pay. But now they've kind of, I guess, broadened that threshold. So instead of 100,000, they're saying up to 250,000. But that may or may not apply. But I've actually called the IRS myself. I've requested installment agreements without financials for taxpayers that do over 100,000, and they were approved. I haven't gone up to 250, but I've gone to maybe 150 or 180. And again, the IRS did agree to the payment amounts without disclosing financial information. Taxpayers with existing direct debit installment agreements can now go online, and if they can propose a lower monthly payment or change the payment dates. So now that's a new option that wasn't available before. So the IRS is offering more online options for taxpayers. Sometimes if it doesn't go through, then the website will tell you, well, you need to call the IRS for whatever reason. A taxpayer, their account can't do it online, but it says, okay, call the 800 number and try to do what if you're lowering your payment, call us. And relief from penalties. So relief from penalties, so essentially we call that a penalty abatement, and that's a request for the IRS to reduce the penalties. And so there's kind of two ways to get penalty abated. One is first-time penalty abatement. It's based on the taxpayer's history. So the IRS looks at the last 3 years. Has the taxpayer timely filed? Have they timely paid their tax? There's no issues on the account. And so based on someone's history, again, it's a 3-year look-back period. They will grant a first-time penalty abatement, failure to file, failure to pay. But if a taxpayer doesn't have a great history in the last 3 years, then it comes down to reasonable cause. Those are generally written statements that we do have to submit to the IRS. Reasonable cause, it's basically based on events that were outside of the taxpayer's control. So illness, death in the family, COVID-19 pandemic, a natural disaster, all those would apply. Reasonable reliance on a competent tax professional, a taxpayer relied on advice from a professional, but they need more than just he said, she said. They do need to provide documentation and support what they're saying. If they have emails, that could be used, saying that taxpayer relied on their CPA, for example, and here's the email. Reliance on IRS advice, and small partnership exception where, if the partnership filed a late return, but the individuals timely filed and timely reported the income, we can actually do those requests over the phone. And if not, we can always mail those in as well. So with penalty abatement, I mean, the IRS, their focus is, if we're doing it based on reasonable cause, we need to provide details, dates, and documentation. So if you're saying, there was a death or illness in the family and you could not timely file your return by April 15, then we would need documentation, medical records, hospital bills, to say, okay, this was happening, for example, in March, even early April, and that would explain why it wasn't timely filed by April 15 deadline. But if there was medical documentation or, like I said, a death in the family that happened after April 15, well, then that doesn't explain, why you didn't file your return on time. So the IRS is going to want, the more evidence we could provide, the stronger the case for penalty abatement. So again, details, dates, and documentation is key to get relief from penalty abatement. IRS collection process and procedures. So essentially, there's tools, and remember, the IRS's job is to collect. So there are some tools that we can use to protect our clients. So if the IRS has issued a final notice of intent to levy or file a tax lien, you do have the right to file a request for a collection due process hearing that does protect taxpayers from being levied. They are entitled to this hearing. So it does put a hold on any collection action until you have a hearing, and even thereafter if you are going to appeal that. So there's always that option. It just has to be within, timely file this 30 days within the date of the notice. If you don't agree with the revenue officer, for example, you can always escalate it to their manager and the territory manager. There's the collection appeal request. So if we have a rejection, termination, or modification of an installment agreement, if the IRS is proposing seizure, levy, and proposing a federal tax lien filing. So those also give us grounds to file a collection appeal. And then tax court. So you can always, so if we have a collection due process hearing and we don't agree and we find that there's abuse of discretion by the IRS appeals officer, we can file an appeal on that notice of determination. And we can always file an appeal on if it's an appeal of notice of deficiency. So that's the last line that got kind of not showing up. So appeal notice of deficiency, that's when the IRS is trying to propose an additional assessment, either from exam or a substitute for return. So just want people to know that they do have rights and they can file appeals. So moving on, another kind of hot topic is, the IRS is sending out notices that if you have balances above 50,000, the IRS can refer your information to the State Department, and this can affect your passport. So it could, you could be denied a passport, it could revoke a passport. So they do send these notices out. Again, the balance has to be above 50,000. If there's a power of attorney form on file, the power of attorney will not get a copy of this notice, so they're just sending it directly to taxpayers. So once the IRS sends this information to the State Department, the State Department can give you an opportunity to respond. And so you can, if it's an error, if you make full payment of the tax, or if you have an arrangement with the IRS, then, you can continue to have your passport and it won't be denied or revoked. And that could be reversal of certification, again, that the taxpayers has paid the tax, or the collection statute expired, or the debt is no longer seriously delinquent, which means that the balance now is below 50,000. And so if you're in some type of agreement with the IRS or your case is in certain type of status, it will not affect the passport revocation or affecting the application process. So if a taxpayer has an installment agreement, if they have an accepted offer in compromise, if they timely filed that request for collection due process hearing, if a taxpayer filed innocent spouse, a taxpayer is in bankruptcy, if a taxpayer is a victim of identity theft, if the account is currently placed in currently non-collectible status, taxpayers in a federally declared disaster area, again, pending offering compromise, or there's an accepted adjustment that will satisfy the debt in full. So if any one of these situations is, applies to your client or a taxpayer, then again, the passport, the IRS will not send that information to the State Department and the passport will not be affected. So it is important to, timely file appeals if needed, and it is important to get taxpayers into some type of agreement with the IRS. And that is it for my portion. So if anyone has any questions.
We do have a few here. I know we are right at time, so if you do need to drop off, go right ahead. Thank you so much for attending, but we just have a few we can address. Does it need to be copies of the receipts for proof, or does a summary work?
For penalty abatement, I mean,
think it was for Stephen
okay.
for 941. I
It
believe.
says for ERC.
The employee retention credit.
Okay,
So are we
yeah.
talking about gross, be able to track your gross revenue, or are we talking about payments? If it's on the gross revenue side, it's comparing your gross receipts, gross revenue for that quarter to 2019 for the calculation change, or for the drop in gross revenue. If it's for something else, please let me know for what your question is.
Yeah, and you can always feel free to reach directly out to us as well. The next question here says, are you saying the IRS can collect from multiple sources? So in this case, it could be collected 3 times, and they're mentioning
Trust fund.
employer, controller, and officer of the company.
Yeah, so that's the trust fund recovery penalty. And yes, the IRS can collect from multiple sources. And, in reality, they don't care where the money comes from. So let's say the controller has the ability to pay the entire tax. If the controller can pay it, then they can take it from the controller, and then the controller has to deal, with the other persons that were assessed and maybe work out something separately outside from the IRS. But yes, the IRS can go after multiple people for the same balance. If the portion of it has been paid, though, obviously they can't collect, let's say the balance is 100,000 and they're able to collect 50 from one person, they can't continue to collect the 100,000. They can only collect the 50 from the other people.
Sounds good. All right, well, those are the questions that came in. If you do have any others, please feel free to reach out. We do appreciate you joining. Have a great day, guys. We'll see you next time.